So thank you so much for being here. We've seen your colleagues frequently at all our investment seminars. Great to have you with us here this morning as well, and thank you so much for joining us. And the floor is yours.
Thank you. Good morning. Good morning, everyone. This classic 1966 spaghetti western launched Clint Eastwood's international fame as an actor. Spaghetti westerns were inspired by American westerns. They were low-budget Italian-made movies that were mainly filmed in Spain and Italy. Let me just get the clicker, apologies. They were also known for, what they were known for was their gritty style and morally ambiguous characters and also violence, aspects all too familiar to us in South Africa. Before I touch on some of the detail, just to point out, Investec Investment Management has always been guided by investment philosophy, which has been shaped by our private client heritage. We have a deep understanding of our clients' needs, concerns, and also emotions around investing. And we have seen how equities have been a very powerful source in wealth creation over time. We achieve this by investing in growing quality companies that can compound wealth over time, and that stood us in good stead through various cycles. So we don't try and time the market too much. We try and find very good shares that we like or companies, and we generally stick to them. The South African economy has been hamstrung by various constraints, but we have a couple of positive things happening for us at the moment. The South African assets have outperformed global assets, like some of the speakers previously had said, and that's for a variety of good reasons. Government borrowing has become a bit cheaper. The rising gold and platinum prices have certainly boosted earnings and also tax revenues. We've seen Chinese stimulus support global exporters, or at least the commodity export companies, and also a revival in Europeans' industrial activity, which does benefit our exports. Additionally, a weaker dollar, which is what we've been experiencing this year, is positive for South African assets. Our inflation is well contained, and I think at the formal income level, things are still, in pretty good shape, and our equities are very cheap. We trade at a big discount to international peers, and we're delivering return on equity way ahead. What's not working, though, is that our economy is growing at snail's pace. The Reserve Bank has been very reluctant or cautious to cut rates. And, in addition, we've seen US tariffs. That's added to global uncertainty. We've also seen that the volatility in the market is a risk for South African assets. The slowdown in the US certainly could harm global growth, and persistent US fiscal risks are also a concern. What is ugly, though, is the structural reform progress that has stalled. We see that the performance has been weaker from the state-owned enterprises. Business confidence is falling. The formal sector is shedding jobs, and we've got way too low capital investment to truly reach our potential from a growth perspective. Our portfolio, however, is positioned in quality financials to try and navigate some of these challenges, also undervalued retailers and some global stocks exposed to some of that global growth. We are selective on platinum and gold, and also on some of the diversified miners. The performance of the JSE Precious Metals Index relative to the index has been volatile. It's rallied about 8 times in the last 6 years. And the performance, year to date this year has been remarkable. We've had, certainly, depends on which index you're looking at, anything between 80 or 90% of the top 10 shares that have come from either a gold or a platinum company. The platinum group metals index is up about 40%, and also the gold. Yet we've seen gold more than double, and also platinum broadly double. The size of the precious metal sector on the JSE has also grown significantly, with both platinum and gold contributing to that growth over time. Just this year, gold has gone from 7% of the index to about 15%, platinum's gone from 3 to 6. These are extraordinarily large numbers for a very volatile sector. The price of gold relative to copper is the highest it's been in the last 35 years. Sort of levels that one previously had at times that occurred during US recessions. The traditional drivers of gold, in higher inflation, the weaker dollar, and also central bank buying have all contributed to this in terms of the increase in the price. But what's given it impetus is, in actual fact, what we see is massive investment buying from the ETF market, and also the Indian imports are at record levels. Can this continue? We actually think all these are in place. They're still in place, all these drivers. We do think there's probably, and from a long-term perspective, more or better value in copper than in gold, but at the moment we certainly are enjoying this run. It's also interesting to note that looking at the performance of the financials on the JSE, it's diverged from the broader index. Financials are up around 4% at the index level over the last year, and the market's up 26%. Historically, financials did a little bit better than the broader market over the medium to long term. We expect that in time, we think there's a lot of value in our financials. So we expect that correlation, or at least that type of performance, to show itself in the market over time. And we're patient. I mean, we long-term investors, we do not, if a stock underperforms for a while, we're very happy to hold it through the cycles as long as we're happy with the fundamentals. So how are we positioned to try and navigate, the good, the sad, and the indefensible of South Africa? Well, as long-term investors, as I said, we favor quality. Thank you.
Clive, thank you very much. Questions for Clive? That was very brief. To the point.
Oh, sorry.
I just want to check quickly, because we've had a lot of exposure to your funds and your business, but maybe just a little bit more background in terms of your stock selection process. You've got a SA equity fund, which is dynamic equity.
Yes.
You've got the general equity fund. But how does the process work? Because, I mean, we're getting to know your firm, but maybe just position that in relative to other businesses, because, I mean, we're all spoiled for choice in the market. Why do we place money with Investec?
Yes. So in the main, the core of our equity fund is committee driven. There where the committees make that decision. But then we do have some pragmatism, or at least flair, that certain portfolio managers might showcase, certainly like in the dynamic equity side. There, Barry Shamley and Peter Vogel, they have the ability to participate certainly in the mid-small cap sectors, whereas in the main, for the main equity portfolio, we are constrained there with liquidity. So your large caps, high quality companies, there we have a group of analysts, but it's a top-down and bottom-up driven process. But the liquidity constraints around the medium and small cap stocks prohibit us from buying that in the fund.
If you had more exposure to mid caps and less to resources, I mean, we all know by now, then you've lagged the market. How do you manage that in a portfolio? Do you then try to play catch up, or do you maintain positions?
Well, it depends. If the fundamentals are still in play, we certainly maintain positions. We've written out positions for a very long time. Our clients are not short-term focused. They are long-term focused. As I say, the average investment horizon for a private client could be anything from 20 to 50 to even longer. So we're pretty happy to ride that out. And if there is some fundamentals that have changed, we might participate. But we are, in the main, if the fundamentals have changed, we will change, which is not capitulation, but it's more fundamentally driven.
There was a question this morning to Simon in terms of, is there a catalyst in the SA market to get some of these positions, some of these companies doing better or not? Rates, a lot of discussions on rates this week. I mean, it's going to be a very busy week. Fed coming out tomorrow, Cyprus also going to make a decision. Do you think that if we see more rate cuts in September and possibly another one before the end of the year, does that impact on some of the positions or some of the smaller mid-cap type companies?
Are you talking about South Africa?
Yeah.
Yeah. So certainly we think it will boost it. So, we think it's been an area where we were hoping to see a lot more interest rate cuts as a catalyst for the South African market. But we've seen a very cautious Reserve Bank, and also with the meddling or the potential change in that inflation target, that's also stymied some of that. I think the small and mid-cap stocks certainly would do better with a bit of an impetus from lower interest rates. And we think they'll really do well with structural changes. I think we've got to the point in the market now where we need some economic policy changes. The way we think about growth in the country needs to change. The way the country's governed needs to change. So there's some serious structural challenges that we have, and I think in the main the market is looking for certainly some evidence of those structural policy shifts. So that's when they'll really do well. We'll have a bit of an impetus from the mid-small cap stocks. But what we've seen is that literally the management teams have generally not been given any love in this market, because the mid-small cap stocks have lagged so much that a lot of them, either there's trade buyers seeing value in it and they get taken out. So over the last sort of 5 years and even longer, we've seen various companies being taken out, which is quite unfortunate. But so we think we'll need to see those structural changes more than just lower interest rates.
Also, Ramaphosa saying as well that they need to take some lessons in how to run things. But let's see, change is on the way, hopefully. Clive, thank you so much for being here with us this morning. We really appreciate it.